This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Thank you for joining us. I'm Gord Long. I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Welcome back, John.
Hey, Gordon. It's been a while. Good to see you again.
Well, we missed last month because of me. We had technical issues on my end, and I apologize because you did a great job, but unfortunately, and John, I need to mention on that, I did a special video with Charles Hugh Smith on problems in the global supply chain regarding quality that stems from cheap money for too long, and now with lack of pricing power, how they're not just cutting costs, cutting corners, and how it's all stemming through. And things like the Samsung 7 battery problem are the beginnings. There are all sorts of issues that are going on in the supply chain that we thought we'd solve 15 years ago with Quality, Six Sigma, Malcolm Baldrige, ISO, all these kinds of things. And the problem we had last week is no excuse, or last month, no excuse. It's just another example of these quality issues that are sinking in on products that are supposed to have been tested. Anyway, now I've got that off my chest. So I want to talk about this month what your views of Trump are, the Trump administration, the Trump presidency. I know you've done some writing, you've been in some ways talking about it. Maybe recap for our viewers, listeners, what your views are on this presidency.
Yeah, okay. Let me start by apologizing a little bit to some of my friends who might be listening here, because I spent the whole campaign teasing my friends on the left about how, you're going to have to treat Trump with respect once he gets elected because it's the office, not the person, just to needle them a little bit, never thinking Trump was going to win. And now he's won. And so it's a much more serious thing for people who, are sensitive to a lot of the crazy aspects of his personality. So I'm not teasing people anymore about what's happening because some of it might be really serious. But anyhow, Trump,
I don't think you were alone on that, John, in terms of not at all expecting him to win. No. And I don't know of anybody I know that thought he would win.
Yeah, well, Trump is part of the trend that began with Brexit, really, where something is coming from so far out of left field that the mainstream and most other people are interested in watching it, but find it unlikely that it will actually happen. And Brexit was down in the polls on the day of voting and still won pretty decisively. Same thing with Trump. All the major polls had Hillary winning by 3 or 4 percentage points overall. And Trump ends up winning pretty decisively in the electoral college, at least. The reasons for that are, many. The polling is a flawed technology now. We can't do it as well as we used to be able to do it. And a lot of people don't want to express controversial opinions to pollsters in any event. So once they get in the voting booth, they follow their heart, but they, don't necessarily tell people about it beforehand. So you get controversial subjects and candidates winning when it doesn't look like they're going to. But the reason that these guys in particular are winning is that the big systems don't work for people anymore. We basically, beginning in 1971, when we broke the final remaining link between the major fiat currencies and gold, we basically turned the governments of the world loose. We gave them unlimited credit cards. And of course, they're going to be corrupted by the ability to make unlimited amounts of money and spend it, And so we ended up with basically an oligarchy now. We've got a financial class and a political class who are an aristocracy who make the rules, but don't have to abide by the rules. So the rest of us are kind of what we could call the unprotected class now. We're the ones who suffer from the negative effects of globalization and free trade and open borders, while the protected class, our new aristocracy, benefit from it. And enough people have figured this out and concluded that The system as it's configured now is something that's worthy of being torn down. So they're open to political candidates and to issues and referenda that that promise to do these kinds of things. So Brexit was going to end a lot of the negative effects of, for instance, free immigration with the European Union for the United Kingdom, and enough people agreed with that they passed Brexit. Trump is going to tear up free trade agreements and close the border and break up the big banks. And you know, enough people saw those things as being negatives in their lives that they're willing to end them. You know, they're willing to break up the big banks, even if that causes some turmoil, or close the borders, even if there are some constitutional issues with that. They're willing to vote for that. And so Trump won. And these guys, rather than being ends in themselves, are really early indications of a longer trend that's going to continue for quite a while. You know, Europe has a Trump-like politician in almost every major country who's drawing a lot of votes. And so each new election is going to be similar to the last presidential election here and to Brexit in the UK in the sense that there are going to be outsiders who have a really good chance of winning, and they won't be completely dismissed anymore. You know, the establishment has to take them seriously because of what's happened in the last couple of major elections. So things are going to be very different going forward, but they're going to be extremely hard to predict anyhow. You know, can Marine Le Pen win in France? A month ago, most people would have said, nah, she'll come in second. That's a guarantee. That's a lock. And now it's not so certain. You know, there's an actual chance that the National Front is going to be the leading party in France, you know, and is going to run the government. They're anti-EU and anti-Euro. What happens then? And Angela Merkel in Germany is losing regional elections now, which implies that her party might not hold power next time around and might be replaced by a nationalist party, you know, the analog of the National Front, only in Germany. And so that could mean that Europe itself, the European project, falls apart. Not just the UK leaving, but France leaving, and maybe Germany deciding to renegotiate the terms of the European Union on a really different platform.
John, and you didn't. We keep on going, but you didn't mention Italy. We have a December 4th referendum in Italy, which could be as big a shock as Trump and Brexit, in terms of whether the referendum is approved, and the government will if it's not, or rather it goes against the government, they'll step down, and then we have Pepe Brillo, 5-star, who could be the dominant party, the former comedian, and could take it. And he is definitely, as you just said, in the same as Marine Le Pen, same kind of anti-EU, though he's not far right.
Well, that's what's interesting about this. It's coming from the right and the left, because people all the way across the political spectrum have reason to be mad. They're focusing on different candidates. You know, Bernie Sanders could easily have been president if things had gone just a little differently here. You know, if the Democrat nominating process wasn't so skewed towards Hillary from the start, Bernie Sanders could have been the Democrat nominee, and he could have beaten Trump. So we could have had a president who's an avowed socialist instead of whatever Trump is, you know. And the same thing in Europe. There are parties of the left like Podemos in Spain and 5-Star Movement in Italy, as you said, who are of the left and sometimes of the extreme left, and they're getting a lot of votes too. So yeah, there's no real way to know how this shakes out except to say that the old order, you know, globalization and free trade and open borders are going to be scaled back almost without a doubt over the coming decade. Now, does that mean that...
Or is this a whole movement towards really anti-globalization?
Yes. Globalization is sort of the umbrella under which a lot of this other stuff has happened. And for the average person, you know, the average physical worker, in other words, say a factory worker in any developed world country, it's not a good deal. And for people in a lot of neighborhoods where immigration is an especially big issue, you know, where new visitors, new immigrants tend to congregate, that also seems like not the influx of Muslims who don't seem to be assimilating, in the opinion of a lot of people who are affected by all the newcomers. That's globalization from their point of view, and it's not a good deal. So they're voting against it. And clearly, there are enough people voting against this kind of thing to win elections and put people in charge who want to scale it back. So here in the U.S., Trump is promising to renegotiate some of these formerly etched in stone trade agreements that basically opens up the U.S. to foreign products and incents U.S. corporations to go set up factories in cheap labor countries and then export back to the U.S. Well, that's obviously a bad deal for U.S. factory workers. And it's obviously going to be challenged by Trump and his people. So if those things get renegotiated, it's hard to say what that means, really, because global trade has been one of the engines of global growth over the past 20 years. It's grown faster than the overall global economy. And that trend has begun to reverse even before this last election. Trade was starting to shrink. If you look at Chinese or Japanese export numbers, they're falling. And that means that the big export powers of the world were already seeing less demand for their stuff going forward. And now, if the terms of trade are going to be changed in ways that are unfavorable for them, they're going to export a lot less stuff. And so we're going to see trade shrink. Now, does that mean the global economy shrinks along with it? Who knows? We don't know what this trend is going to mean. In the past, when you had big spikes in protectionism, which, by the way, normally flow from financial crises, the 2008-2009 Great Recession is still having its impact because it changed a lot of people's opinions about the way the world works and how dominant we can be in the world. And if we can't benefit from rising free trade, which it seems that we can't now, we're going to vote against it. And so, we're still feeling the effects of that with another financial crisis coming our way. So when the next crisis hits, and it might hit pretty soon because we're 7 years into a recovery that has involved immense amounts of new debt. If you add it all up, the global financial system added somewhere around $100 trillion of new debt since the 2008-2009 crisis. So we had a crisis that was caused by excessive leverage in the banking and general financial system. And instead of addressing that excessive leverage, we increased leverage going forward. We took on even more debt because that's all we know how to do now. All we know how to do is borrow money and spend it. There are no other policy tools out there with which governments can affect the course of their economies. So we did what we know how to do. And in the process, we created the conditions for an even bigger crisis going forward. So if politics is crazy now, during a recovery after a crisis that happened 6 or 7 years ago, imagine what politics will be like when the next stock market crash happens and the next near-death experience in the banking system happens, or when the next wave of bankruptcies across the industrial part of the country occurs. That's going to radicalize people even further. And to the extent that a Donald Trump wins in a squeaker today, they're going to win by a landslide in the next round of elections. So what's happened lately is just the beginning of a process that's going to get a lot crazier before it calms down.
We're looking for significant political shocks, like I can call them that, throughout 2017, exactly as you're describing, John. And when you overlay them with, we're going to see a recession at some point coming in the U.S. We think we're very close to it. You overlay it with protectionism and that is stemming from really the backlash, and we can go on about the other problems that you just identified. It's a very risky time, What is your prognosis in terms of Trump's policies as being pro-growth? Could they be, or is there potential for them to be pro-growth?
Well, what used to be pro-growth? In the 1950s, the Eisenhower administration did a big infrastructure build out. They built the interstate highway system. and it stimulated the economy, and we didn't fall into a recession after the end of the Korean War, like we might have when we brought all the soldiers home. That eased the transition. In the 1980s, the Reagan administration did serious across-the-board tax cuts and a military buildup, and that generated a lot of economic growth. But the difference between now and then is that back then we had pretty solid balance sheets. In the 1950s, we had a really minimal debt as a percent of GDP in the private sector. There just wasn't a lot of consumer debt out there. The government still had some debt from World War II, but the average person did not have much debt. Credit cards weren't widespread, and mortgages were hard to get and usually for low dollar amounts. So we weren't already highly leveraged. Same thing in the 80s. After the 1970s inflation, the real debt load of the system was pretty low. So we could borrow money and spend it and get a pretty good bang for our bucks. Well, now we're at the other end of that spectrum. We've been borrowing money, nonstop for 30 years. And the marginal productivity of debt, in other words, the amount of new growth we get from each new dollar borrowed, has fallen from 6 or 7, or from 1 to 1. In other words, you used to borrow $1 and invest it, and you got $1 of growth. Well, now we have to borrow $6 or $7 to get $1 of growth. And that trend is heading towards zero at a rapid rate. So at that point, you can borrow as much as you want to, and all you get is more debt. You don't get any more growth. And if it falls to negative, which it could easily if this trend continues, then you borrow money and you actually get less growth because the debt load is more and more onerous, and the interest cost is higher and higher, and you don't have any money left over to spend on anything productive. We're heading for that point at a rapid rate. And so if we're going to borrow tens of trillions of new dollars for whatever, infrastructure or tax cuts or some kind of guaranteed national income or whatever it is the government does next, it's not going to work. We're going to get what Japan got with its last batch of borrowing, which is to say not much of anything. All they did was just add to the national debt with the deficits they've run in the last few years. They're not growing or anything. They don't have inflation. They're still in deflation, and the economy is kind of flatlining. So we're headed for that, and that's the best case scenario. If we just flatline for a decade, no new growth, that's better than what we'll probably get, which is a massive financial crisis. 2008, 2009 on steroids, where some sector of the economy starts to implode, whether it's the auto industry because we've already, given an auto mortgage to everybody who can possibly handle it, or housing, or the big banks, or the hedge funds, or somebody else that's got too many derivatives. There are a lot of things that can blow up out there, and that's leaving aside the whole geopolitical thing where we're kind of rattling a lot of sabers around the world, and we could easily get into some kind of shooting war that makes people think we've got World War III on the horizon, and that would do it too. So lots of things can stop this recovery in its tracks. And if that happens with all this new debt that we've taken on, then it doesn't matter if we build a few new roads or bridges or airports or whatever. We're in big trouble, and that's the likely scenario. And it's likely that to the extent that we borrow a lot of new money and spend it, that we're just going to make things worse. So yeah, I don't think that anything Trump can do now that's on the conventional spectrum. In other words, easy money, more government spending, stuff like that. There is no solution on that spectrum of policy options. But that's all we seem to have. It's all we recognize as possible. So he's going to do that, it sounds like. And infrastructure spending is such an easy sell across the political spectrum.
John, is there any chance that a different approach in terms of regulatories, changes in paperwork and government regulations, specifically cutting back in some of the elements of Dodd-Frank, which Trump has talked about, is there potential for leverage there of helping to improve the economy?
I have no idea what Dodd-Frank does. It didn't affect the behavior of the big banks because they increased their derivative books. They now have a bigger share of the U.S. mortgage market than they did before the financial crisis hit. So it's possible that getting rid of Dodd-Frank actually disadvantages the big banks in some way. And leads to less growth, at least as generated by Goldman Sachs and JP Morgan Chase and guys like that. And Trump, I thought, ran on the platform of breaking up the big banks and reimposing Glass-Steagall, which was a law passed after the Great Depression that separated commercial banks from investment banks, and in that way stabilized the industry. You don't hear that anymore. I think he got co-opted by Wall Street instantly. The minute that it looked like he was going to win, there were some phone calls, and you don't hear about Glass-Steagall anymore after that. And meanwhile, it sounds like they offered the Treasury Secretary job to Jamie Dimon, who's the head of JP Morgan Chase. So it sounds like whatever regulations come our way are going to be really Wall Street friendly. And that's not going to help a thing. Wall Street is, as voters understand now, is an aristocracy that exists to siphon money out of the accounts of regular people and into the accounts of the 1%. So to the extent that we've got Wall Streeters running the financial system still under a Trump administration, nothing gets fixed. It'll be a continuation of the George W. Bush administration and of the Obama administration, which is to say Wall Street basically in charge of the financial system. So now I don't see any regulatory fix to a system that's this highly leveraged. So actually, I don't see any fix from any direction.
I was going to say, I don't think whether it was going to be Hillary Clinton or Trump. It sounds like it wasn't going to make as many difference.
No,
John,
not in the end.
John, how would you make money in this era of Trumponomics that's coming in front of us? Is there an opportunity for our listeners to make money?
Well, we need to understand that Trump's policies sound in a lot of ways like something that Paul Krugman would design. In other words, a massive infrastructure build out. I did an article on dollarclaps.com a while ago about how Krugman's going to get his alien invasion. He's on record as saying that the threat of an alien invasion would be good for the economy because it would force the government to ramp up military spending. Well, he's going to get basically that now. And to the extent that Trump's people are alien to the Beltway mainstream, then it's literally an alien invasion. But we're going to get infrastructure spending, which the left loves, and we're going to get a ramp up in defense spending, which the right loves. So these things are going to sell very easily in Congress. They'll definitely be passed if they're proposed. And that's going to pump up, quote unquote, aggregate demand in the short run. In other words, the government's going to borrow a lot of money and spend it on stuff which requires hiring people. So there will be a few more jobs. Those people will spend that money. And so you might get a little pop in nominal economic growth, but it'll be at a cost of ridiculous amounts in new debt. Now, that's an environment that's pretty ideal theoretically for precious metals, because when you got the government just ramping up spending like crazy and then printing whatever money it takes to finance the new debt that they're taking on, that tends to destabilize the currency. Because see, none of this would work if the dollar goes up in value in the process, right? Because that is like a big tax increase on multinational corporations. So we'd see corporate earnings plunge if the dollar went up because of all this. So they have to lower the value of the dollar if they want any of this to work. So there's our next 5 years: massive increases in government spending, massive increases in money printing, and an attempt to devalue the dollar. Well, that's paradise for precious metals. So gold and silver, one asset class that ought to do well in this kind of an environment. And I'm really not sure what else works now, because across the board equities, the S&P 500 is at record levels in terms of valuation. So how much higher can you go if you're already at levels that in every single time in the past have preceded a crash, right? And bonds are at the tail end of a 20-year bull market. Interest rates are at record low levels, and they've spiked a little bit lately, which is probably terrifying the guys at the Fed and Treasury right now, because they understand that a spike in interest rates is bad across the board. Mortgage rates go up, housing craters. Government interest costs go up, the deficit soars. That's not an environment in which the economy will be stable. It'll probably be really unstable and with a negative bias. So it's not clear what combination of policies would give us stability and growth going forward, or if any combination of policies would. But I think it's pretty clear that the stuff that they're going to try is the kind of thing that gets people excited in the short run because they look at, oh, jobs, tax revenue, stuff like that, but that destabilizes the system in the long run. And that's almost certainly what we've got coming, because the public policy mix is pretty much predictable right now. They're going to do this stuff. And history says that a predictable set of outcomes follow from something like that. So here we go. We'll see.
Yeah, and it's interesting, and everything you just said, John. The reaction to these policies, the articulate that Trump is expected to bring in. What we've seen is the bond market go through the yields go through the roof in terms of a size of move. We've seen the dollar going to significantly new highs, but at the same time, gold has been steadily weakening all the way across the board. So there's really a tremendous amount of conflicting signals that are going on here that are in the short term somewhat unclear. Comments on that?
Well, yeah, it's a risk-on trade right now. In other words, people are optimistic that there's going to be growth going forward, and that's going to solve all our problems. So they're buying equities, they're selling bonds, which are a safety play, and they're selling gold, which is also a safe haven. But when it turns out that we get relatively minimal growth and accelerating inflation, or volatile interest rates, or some other sign that it's not working, then that'll reverse big time. This is a very, very temporary environment. And we'll see money flowing back into safe havens. The question is not whether gold is going to be a beneficiary of this, because it will, but the question will be whether bonds are also a beneficiary, because it's possible that the bond market is the epicenter of the disruption that's coming. And so we get a bear market in bonds, which gives us a bear market in stocks, but that sends a lot of terrified capital into gold, which is kind of what happened in the 1970s. We had a horrible bond bear market, and stocks went up, but not nearly as fast as the inflation rate. And so you lost a lot of money in bonds, you lost in real terms in stocks, but you made a lot of money in gold because it went up even faster, and silver went up even faster than gold. That's kind of our best case scenario is the 1970s again. And that was a really chaotic time. But now we should be lucky to get something like that, because back then we had a pretty decent, as I said, national balance sheet. We were in pretty good shape financially, so we could weather that storm. And we fixed the 1970s with really high interest rates in the early 1980s. The Fed funds rate went to double-digit levels, and Treasury bonds were 15 or 16% back then. Well, if we did that now, the world would end as we know it. We'd be like a Mad Max kind of scenario across the developed world. So we can't do that. We don't have a fix for the kind of instability that we saw in the 1970s. So if we get that, it probably won't end the same way. But if we don't get that, it'll probably be worse right away. There's no real way to get a good outcome from it. You just can't fix this painlessly. And I think probably what they're going to end up doing is roughly the same thing that they would have done under Hillary Clinton, which is to say, we need some kind of a debt jubilee. We just can't get out from under this debt without writing a ton of it off. And what that will end up meaning is that all the cash that was generated and created as part of the government borrowing all the money that they borrowed in the last 30 years will still be out there in the system. But the liabilities, the bonds that someone has to pay off will be wiped out. That's extremely inflationary. That means the asset side of the balance sheet, the debts, the cash that's in the system becomes relatively bigger. And that we're now going forward just financing the government by printing new money. We're not taking on obligations that we have to pay off and which then limit future spending or anything. We just open the floodgates, and people will figure that out. And historically, debt monetization, in other words, when the government just says, yeah, you know what, forget it, we give up. We're just going to print as much money as we need to maintain stability and get us through the next election. That usually precedes some kind of a hyperinflation. And people will figure that out and act accordingly. So you'll see this massive shift out of financial assets. Nobody will want to hold that cash that's being devalued so aggressively. And they'll shift it into real assets. They'll buy farmland and oil wells and well-chosen real estate. Although they'll buy all kinds of real estate, but only the well-chosen, low-leverage stuff will actually end up being a good investment. And they'll buy precious metals. So we'll see this massive shift into real assets that will drive the relative value, the local currency value of those things a lot higher. And it'll manifest as inflation. It'll look like inflation, but it'll really be a collapse in confidence in the currency. That day is coming. We've put ourselves into a box where the only policy options lead to something like that, and maybe sooner rather than later.
John, some very, very well thought out insights, and I'm sure are a lot for our listeners to think about. We will certainly incorporate, overlay, and test a lot of your thinking with some of our conclusions we're coming up with at MATA SII in regards to investing in this era of Trumponomics. It's risky no matter how you look at it, because so many things have yet to unfold. But there are certain ones that are given, that are going to unfold. It's just the degree, as you mentioned earlier, things such as infrastructure right off the top, that'll unfold, but to what degree? There will be increases in defense, but the point is in what form or shape, etc. John, what any last concluding comments you'd like to share? We've been a little negative here this morning, and I don't want to leave our listeners on a negative part. Are there any positive points you'd like to make?
Yeah, well, in times like this, when the world is heading in the wrong direction, that's still an investment thesis. You can still make a lot of money by being on the right side of these big upheavals. And as I said, precious metals in times of upheaval tends to be the place where people hide out. Lots of money flows into them, and they go up even relative to other assets that are going up. Gold and silver ought to be the best performer out of the safe haven asset classes. So, in a sense, this is an optimistic discussion, because what we're really talking about is, here's how you make money from this crazy stuff that's happening. We can't affect the political system. We can't stop the global economy from heading off of the cliff that it's heading off of. But you can protect yourself and your family, and maybe actually make money as all of this goes on, and so that you're able to still have a good life where you have a certain amount of control over your destiny, while your friends and neighbors lose a lot of control over their own destinies. So this is an important time. Investing, it's always an important time for managing your money, but this is a crucial time, because if you get this right, you sail through what's coming relatively unscathed. And if you get it wrong, you lose control of your destiny, because your job might not be secure. Your local economy may not work the way it used to, and all that's left is your nest egg. And if your nest egg is growing, if your capital is growing, then you can at least protect your family, and that's what we should be looking at now. We can't fix the world, but we can fix our own little corner of it. We can tend our own garden, and we can make sure that garden sustains us, whatever comes.
Well said, John. We echo that exactly the same way. John, how can our listeners follow all of your writings, your podcasts, etc.?
I run dollarclaps.com, and that's a site that's updated continuously that covers most of what you and I talked about today. And my most recent book is The Money Bubble, co-written with Gold Money's James Turk. It's available on Dollar Collapse and also on Amazon.com.
And they can sign up for your newsletter or your terms of publications?
Yeah. There's a link on the site that you can enter your email address into, and then you'll get whatever I write or whatever podcast I do going forward.
John, I'll let you go, and I wish you a happy Thanksgiving.
Thanks, Gord. You too.
And I know we'll have a completely different discussion next month. Maybe we'll be talking about the fallout of this Italian referendum, but I don't know.
Maybe.
I think there could be a shock arriving there too. Talk to you next month.
Okay. See you, Gord.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.